I mean, ADP yesterday was pretty hot. Having said that, it's really difficult to predict and rely upon headline NFP number, right? We have seen a lower participation rates in poll. We have seen a consistent downward revision in prior numbers, as well as there are factors like swings in immigration. So we are not as concerned on a single number per se in job market. However, we do look at US job market on a holistic basis, and it's not really painting a really optimistic picture to us for the second half, right? We are talking about very low quit rates. We are talking about US layoffs at the highest level we have seen in last 12 months. And job creation is really focused on part-time side of the market. So all of this really pointing us towards a softer job market as a whole. And as a result, I think the single NFP print is not really dictating the asset allocations we are following at our end. So yeah, I think overall we still expect a soft NFP print, a bond-friendly NFP print tomorrow, and that's how we're analyzing markets at this point in time.
Okay, so elaborate for me. What does soft look like?
So market consensus is still about 200,000, around 200,000 jobs tomorrow. I think even if we have an initial, spike higher than that number, I don't think markets are going to react to that number, considering, the follow-up information under the hood information, which usually pointing to a softness as a whole. So around 200,000 is still something which we're expecting tomorrow.
Okay, so what does Powell's wait-and-see approach to cutting rates mean for your own fixed income strategy? It's interesting to look at this from a fixed income perspective because there's a lot of moving parts here. So walk me through the options you're putting in place now. Walk me through the strategy you're putting in place to navigate this.
Absolutely. We are over a duration versus credit risk at this point in time. We have seen almost 50 to 60 basis point pickup in long and bond yields since the lows we saw in the fourth quarter of 23. I think it's an opportunity to us. I think we're buying those spikes ahead of seasonally strong months for Treasury. And we believe that there's a 100 basis point duration trade live somewhere between now until the end of the cutting cycle. That means staying over long duration portion of the emerging market. We do like KSA, Abu Dhabi, Qatar in that part of the world. And credit risk, we are not as bullish as we were in the fourth quarter. Valuations are looking stretched. There's no imminent positive catalyst for this space to perform. Having said that, there are pockets of value. We do like names like Egypt, and Turkey. We have seen a significant easing in financial conditions of these sovereigns recently. Though we have seen spreads going down, the improvement in fundamentals is not fully reflected yet in spreads. As a result, we expect another 50 to 60 basis point rally in spread for names like Turkey and Egypt. So that's where we see value on high yield side. But still, duration is the biggest overweight going into this quarter, and we're sticking to our guns for this year on that call.
Okay, sticking to the guns, duration risk over credit risk. Any other opportunities we should be watching or anything else viewers need to know as the rest of the trading day gets underway?
Not really. I mean, the valuations, we something which is really, really on the tighter side of the spectrum. And I think you got to be selective. You got to be diversified with your allocation. As far as the Middle Eastern markets are concerned, I think there's geopolitical risk on top of credit and duration risk, which are talking about the general bond market. So I think staying selective, diversified, focusing on high quality portion of the fixed income has to be the way of investing going forward this year.